Time now to take a look here at some of the large cap growth stocks. They've been so popular, but they've been underperforming a little bit in the past 6 months after hitting some highs in early September. So what does that mean? Does that provide a buying opportunity by chance? Well, let's ask Chance Finucane, partner, chief investment officer at Oxbow Advisors. Large cap growth, I mean, it's just something that we love to love, but hasn't treated the shareholders quite as nicely of late. Are they attractive now, once again?
Hi, Nicole. Yeah, we agree. I think that they are attractive, especially compared to small caps or some of the sectors that have done really well in the last 6 months, like energy or financials. We're not saying anyone that's benefited from those runs in those sectors or in that asset class should sell in those areas yet. But if you have some new money to put to work, we think some of the large cap growth stocks that have traded off since last September are the best places to be putting some new money.
It makes sense. I mean, so you're saying don't sell off what is working at this time, but you do have 3 names here: Amazon, Facebook, and Alibaba. Tell me about these 3. Is one of the 3 really your favorite?
I don't know that you can say one of the 3 is the favorite. For new clients that have been entering our equity strategies, we've been buying full positions in all 3 of them. For Amazon, I think the attractiveness is that it actually behaves defensively in the marketplace, which may be counterintuitive to people who think about Amazon as a fast-growing tech company, but they almost behave more like a fast-growing Costco. They provide essentials to consumers and businesses. And you can look back a year ago when the CEOs of Netflix and Zoom both said that there's no way they could have held up with that increase in demand among consumers and users without Amazon Web Services. So the consistent 20% growth in free cash flow in Amazon is something you can rely on as a defensive stock in your portfolio. For the other 2,
that's an interesting one. That's an interesting one. And what about Facebook?
For Facebook, I think it's just the idea that while people are paying attention to the political atmosphere related to Facebook, which we monitor, what's most important for that company and its stock is that its users and the advertisers wanting to advertise on Facebook or Instagram are still engaged with those apps, which, as far as we can tell, the engagement is still strong. So between that and the huge international opportunity that still is there for Facebook across its apps, we think it's a good time to move in, especially considering that it has a higher free cash flow yield than the overall S&P 500.
And it really has been beaten down double digits right now at 256. Where do you think it's fairly priced, or where could it go?
We would say it's worth more than $300 today. I think for us, we're excited about is that they continue to grow their free cash flow at a rate that's at least double what the market is. So if you're paying a cheaper free cash flow multiple while getting faster growth, and it's a company that has no debt on its balance sheet, we think that's a pretty good spot to be when you're looking out the next 5 years.
And then Alibaba, a quick thought there.
Yeah, Alibaba is one that's come back down 20% in share price in the last 6 months, even though it's grown its cash flow 20% over the same period. They continue to do well. It's the largest e-commerce player in China, but it's also hands down the largest cloud player in China. And we've seen how successful Amazon Web Services and Microsoft Azure have been in the US. That's just getting going in China, and I think that's going to be a real growth lever for them over the next 5 or 10 years.
And you know, I wanted to ask your opinion because another big growth stock, we always talk about FANG and Microsoft and things like that. Microsoft got a good call from Citigroup today, talking positively about it, one of its favorite names in software. Do you have any thoughts on a name like Microsoft?
Sure, we like Microsoft. It's one of our largest positions for clients that are in our equity strategies. We've owned it for years. I think it's probably not quite to a price where you would say it's undervalued. If you own it, we would say keep the shares. We would look for a little bit more of a trade-off in the future before we would try to add more to new accounts.
Yeah, so you're not surprised to see it being called a top pick over at Citi. All right, Chance, thank you so much. It's great to chat with you. Chance Finucane, partner, chief investment officer at Oxbow Advisors. Thank you.